Hi everybody, Thomas here at Rebel Income. Paying attention to market news means trying to make sense of the opinions of the analysts and experts that are paid to get you to tune in. Following their latest earnings report, Jim Cramer was asked his opinion about CVS Health, one of two remaining national drugstore companies in the United States, citing not only their lackluster first quarter report compared to Wall Street estimates. Cramer also pointed out management's adjusted lower forecast on its full year outlook, as he called CVS just a bad business. As somebody who's followed CVS for some time, Cramer's opinion sparked my interest. Not because I agree with him, but because at the time the stock had plunged more than 18% overnight after that earnings report. As a contrarian, having popular market media start talking in bearish terms about a stock actually piques my interest, because that's where I often find really good companies trading at deeply discounted prices. CVS is the largest pharmacy healthcare provider in the United States. That combination is relatively new and reflects efforts by CVS and its primary national competitor, Walgreens Boots Alliance, to transform their businesses from retail drugstores to localized service centers for a range of services from primary care, health insurance and prescription benefits management, and more. For CVS, that transformation has been going on since 2018. When it merged with Aetna, the third largest health insurance company in the United States at the time. Challenges to growth in the healthcare business include disruptive competitors like Amazon and Walmart. Walmart recently disclosed they were closing all of its healthcare clinics across the country, as well as its telehealth provider, due to rising costs and a difficult reimbursement environment, which has also raised questions about the viability of CVS's new business model. Perhaps offsetting some of those challenges is the fact that where Walmart sought to enter a market with high barriers to entry, CVS has either dominated its business space or acquired businesses like Aetna with a proven track record of success in a market it sought to enter. That implies a completely different level of management expertise, including an executive group at the top of the organization with a proven history of successfully integrating new businesses under its umbrella. Let's see if the company's fundamental and value metrics line up to offer a good long-term value-based opportunity. Over the last 12 months, earnings declined by 40.5%, while sales were 3.7% higher. In the last quarter, earnings fell by 38.2%, with sales declining by 5.73%. CVS operates with historically narrow profit margins that have slipped lower. Over the last year, net income was 2.03% of revenues, but dropped to about 1.3% in the last quarter. CVS has generally healthy free cash flow. However, this number declined from $17.6 billion a year ago to $8.1 billion in the last quarter. Along with the pattern of declining net income, the drop in free cash flow confirms some of the company's present operating challenges. CVS has both healthy liquidity and more than adequate financial ability to service their debt through cash flow, despite the declines I just mentioned. In the last quarter, total cash and liquid assets were about $13.1 billion, while long-term debt is high but serviceable at about $57.7 billion. The annual dividend for CVS is $2.66 per share. At the stock's current price, that translates to a very interesting dividend yield of 4.77%. It's also worth noting that the latest increase in its dividend came at the end of 2023 from $2.42 per share. An increasing dividend is a strong sign of management's confidence in their business plan. There are a lot of ways to measure how much a stock should be worth, but I like to work with a combination of price to book and price to cash flow analysis. Together, these measurements provide a long-term target at about $66.30 per share. That suggests that the stock is undervalued, with about 19% upside from its current price. CVS has been following a clear downward trend since a peak above $108 per share to start 2022. Following the latest earnings announcement at the start of May, the stock dropped from about $68 per share to $55, where it's managed to stabilize since. That puts current support for the stock at $55, with immediate resistance at about $57. A push above $57 per share should find next resistance at about $63, while a drop below $55 should test the stock's multi-year low at around $52 per share. That's a level that was last seen in late 2019 and early 2020. There's no doubt that CVS is facing some clear headwinds in its business, which is why the market has pushed the stock down to its current levels, and why I think analysts like Jim Cramer are taking such a negative view of the stock right now. That said, I believe the market is repeating a mistake that I made in 2019 when I took a bearish view of the company's merger with Aetna, only to see this business make valuable contributions to the bottom line and spur growth that continued through the next 3 years. That's good news for bargain hunters like me, with CVS offering an interesting value proposition for long-term growth, along with an attractive dividend for useful passive income in the meantime. If you like this video, go ahead and give it a like. Help me grow my channel by hitting the subscribe button, along with the bell so you'll get notified every time I upload new content. If you really want to leverage the power of my Rebel income system with information you can use every day, sign up for a free 7-day trial on my Patreon page. That link is in the description area of this video. Thanks for your time. I'm Thomas. Talk to you again soon. Happy investing, everybody.